Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to share today's topics with you. We're starting off with a look at the current state of the Indian stock market. The Sensex has seen a lackluster performance over the past year, with returns that have been, quite frankly, underwhelming for investors. But what's behind this trend? Is it a result of global economic uncertainty, or are there domestic factors at play? According to experts, one major factor contributing to this sluggishness is the persistent selling by foreign portfolio investors, or FPIs. They've pulled out a significant amount of money from the Indian market, reallocating their investments to other countries with more attractive returns. The Indian rupee's weakness against major global currencies has also played a role in this decision. Another key factor is the modest growth in corporate earnings. The Nifty 50 companies have seen limited growth, with delayed demand recovery and input cost pressures weighing on margins. This has led to a time correction phase in the market, where valuations remain elevated and prices are consolidating rather than declining sharply. Now, it's not all doom and gloom. Despite the FPI selling, mutual fund SIP inflows have remained strong, cushioning the market from a deeper fall. Retail investor participation through SIPs is still robust, limiting downside pressure. And with anticipation of additional policy actions that could support the market, such as a potential CRR cut by the RBI, there's hope for a turnaround. Experts believe that the earnings cycle is bottoming out and that strong fiscal and monetary stimuli could catalyze a consumption-led macro recovery in the second half of the current fiscal year. They see any significant correction as an entry opportunity for long-term investors. So, what does this mean for you, our listeners? It's essential to stay informed, be patient, and not make impulsive decisions based on short-term market fluctuations. We'll continue to monitor the situation and bring you updates and insights from the world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and economics in our middle segment today. The recent interest rate cut by the U.S. Federal Reserve has sent ripples across global markets, and we're here to break it down for you. The Fed's decision to cut interest rates by 25 basis points, bringing the federal funds rate to a range of 4.00%–4.25%, marks a significant shift in monetary policy. This move is expected to have far-reaching implications for commodities, currencies, and central bank strategies worldwide. Let's start with the impact on the US dollar and global currencies. Typically, interest rate cuts weaken the dollar, making it less attractive to foreign investors. And that's exactly what we're seeing. The dollar index has softened, with major currencies like the euro, yen, and pound gaining ground. This trend is expected to continue if further easing materializes, especially if inflation remains elevated and real interest rates turn negative. Now, let's talk about commodities. The Fed's dovish pivot has created a mixed bag for commodity markets. Precious metals like gold and silver have surged to record highs, with gold breaching 3,700 ozus and silver crossing 42 ozus. This rally is driven by expectations of lower real interest rates, geopolitical uncertainty, and central bank buying. On the other hand, base metals like copper, zinc, and nickel are responding variably to the Fed's easing stance. Copper has emerged as a standout, surging to $10,190 engotten on the London Metal Exchange, supported by dollar weakness and robust demand from China's infrastructure and EV sectors. However, volatility persists due to trade policy risks and tariff exclusions. Energy prices, including crude oil and natural gas, remain steady, with Brent hovering around 68 and WTI near 63.5 per barrel. It's essential to note that the Fed's rate cut is not just a domestic monetary adjustment, it's a global signal. As central banks, investors, and commodity markets respond, the ripple effects will shape asset prices, currency dynamics, and economic trajectories in the months ahead. To summarize, The U.S. Federal Reserve's interest rate cut has set off a chain reaction in global markets. While some commodities like gold and silver are thriving, others like base metals and energy are experiencing mixed trends. As investors and market participants, it's crucial to stay informed and adapt to these changing dynamics. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're closing out today's episode with a fascinating story that highlights the delicate balance between monetary policy and politics. As we've been following the developments in the U.S. economy, it's clear that the Federal Reserve has been under intense scrutiny, particularly from the Trump administration. Now, let's dive into the details. The Fed recently lowered its benchmark interest rate to the 4% to 4.25% range, a move supported by most of the Fed's policymakers. However, what caught our attention was the arrival of Stephen Moran, a new appointee to the central bank who retains his role with the Trump administration. This has raised questions about the independence of the Fed and its ability to make decisions without political influence. On one hand, Moran's appointment could be seen as an attempt by the Trump administration to gain more control over monetary policy. However, in an interview, Moran emphasized that he will conduct independent analysis based on his interpretation of the data and the economy without any pressure from the White House. It's worth noting that the Fed's legal mandate is to aim for maximum employment and stable prices, and its decisions should be guided by these objectives rather than political considerations. The fact that most Fed policymakers supported the recent rate cut suggests that they are committed to supporting the labor market and achieving their dual goals. As we analyze this situation, it's essential to consider multiple perspectives. Some might argue that the Fed's independence is crucial for maintaining trust in the financial system, while others might see Moran's appointment as a necessary step to ensure that the central bank is more responsive to the administration's economic priorities. Ultimately, the relationship between the Fed and the White House will continue to be closely watched by investors, policymakers, and the general public. As we navigate these complex issues, it's essential to remain informed, critical, and nuanced in our analysis. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.